Early last week, while looking at every piece of research imaginable in preparation for earnings season, a pair of earnings previews from Netflix hit my eye. On the one hand, Barclays downgraded Netflix to underweight, meaning sell, while a separate team at Piper Sandler gave the stock an upgrade, taking it to overweight, meaning buy. At the time, I highlighted the analyst face-off, and by the way, I stuck my neck out and I said, the bulls will be right. And you know what? Oh, I'm basking. It feels great to say I told you so. When Netflix reported last night, it shot the lights out, which is why the stock caught fire today, up $76 or 11% to a new all-time high. Congratulations to the team at Netflix. You are really good. This was truly a fantastic quarter. The company posted a solid revenue beat, 15% growth. The bears were worried about profitability. Well, guess what? Netflix operating margins came in 29.6, in line with expectations, up from 22.4 in the same period last year. All told, they earned $5.40 per share, 28 cents ahead of the estimates. That's 45% earnings growth. That is a resounding victory for the bulls. Now, to be fair to the bearish analyst at Barclays, he wasn't really necessarily saying this quarter would be a disaster. His negative outlook was longer term than that. But the results we got last night certainly take some of the wind out of the bears' thesis, and you sure wish you hadn't shorted or you wish you had bought it. Maybe that talks you out of buying it. Barclays was worried about what they call, quote, unrealistic long-term margin expectations, quote, which is hard to take seriously until Netflix starts missing the margin estimates for those, certainly. Longer term, the bears fear that Netflix will have to lean on new growth levers to maintain its double-digit revenue growth rate, and that some of the levers they've already pulled, like paid account sharing, are pulling that growth forward. Again, it's only one quarter. But Netflix had net subscriber additions of 5.1 million. Boy, is that ever organic. Much better than the 4.5 million that Wall Street was looking for. They also, by the way, when you listen to the call, there's so much expansion that could happen. Of course, look, the bull versus bear argument came down to the stock's supposedly premium valuation. But the valuation is based on future earnings. So let's talk about the company's guidance. Management forecast for the current quarter was terrific. Better than expected revenue, better than expected operating margin, better than expected earnings. And the party didn't end in the fourth quarter. We went to guidance overtime, with management also giving us the preliminary outlook for 2025. For next year, Netflix is forecasting 11 to 13% revenue growth, operating margin around 28%, both in line with expectations. Remember, those concerns about whether these guys could maintain double-digit revenue growth? Well, Netflix clearly thinks that won't be an issue in 2025. Never a great sign when your negative thesis gets batted down by management's outlook for the next year before you even have time to buy this year's Halloween candy. We bought a lot of dots yesterday for like the dot plot joke, and that's what I'm going to give away. Not the individual. I mean, just give away the whole boxes. Come to my house. That said, there's more to Netflix's premium valuation than just the numbers. If you listen to last night's conference call, which is such a hoot, co-CEO Ted Sarandos, whom I love, did a great job of breaking down just how expansive their library of content's become. He talked about the benefit Netflix saw for the return of fan favorites like season 4 of Emily in Paris, season 8 of Selling Sunset, season whatever of Cobra Kai. Some of you are probably sitting around saying, wait a second, I've never heard of these. Or how did a Karate Kid spinoff get a 6th season? But that's just how huge their library is. Netflix can keep pumping out multiple seasons of popular shows that you've never heard of, maybe because their algorithm knows it's not your style. They got something for everybody. That's the point. As Netflix explained on the call, this content library is sucking people into the point where they're now averaging 2 hours of viewing per member per day. You probably ask, how could someone watch 2 hours of Netflix per day? I said that to myself last night while watching 3 hours of the worst football I've ever seen in my life. Now, there's a huge part of their advantage. To quote Ted Sarandos, quote, we're seeing a lot of our competitors use bundles to find growth in their businesses, end quote. And they have to offer these bundles, as Sarandos puts it, quote, given the narrow scope of the libraries on these services and the fairly limited engagement. Ooh, that was so brutal. Ooh, so accurate. The legacy media streaming services just can't compete with their wide assortment of police procedures, fireman shows, hospital dramas, and just all-around shoot-'em-ups, because that is so not what Netflix is about, huh? Isn't it funny? They were doing the same thing as we did when I was in college. There's something wrong there. And this gap seems like it's getting wider, frankly. While legacy companies try to bundle their narrow streaming libraries, Netflix is adding more and more value, going all over the world, getting great stuff. These shows just keep coming. Outer Banks season 4 out now, season 2 of Squid Game coming up, and don't forget the Christmas Day NFL games. And listen to this; these are really good. They got a doubleheader: Chiefs versus Steelers. Okay, Steelers got a good D, but then how about this? Ravens versus Texans. That could really wreck Christmas. Just a really great lineup for Netflix's first foray into live football. I could use a Perfect Couple season 2 or 3 or 4. Oh, come on. Perfect Couple into an eternity. After listening to management's rattle off their current and future content slates, I started wondering, how the heck can people only watch 2 hours per day? They have, and considering Netflix disclosed that their share of TV viewership is still less than 10% in their biggest countries, I could see that number going up. Honestly, just keeping up with all this programming is practically a part-time job. So glad that they tell you what people are watching all over the globe before I get started. All this content just makes it more likely that Netflix's move into ad-supported subscription plans will make a difference. There's been a lot of focus on the ad tier, and with the company putting an end to subscriber disclosures next year's management shifting attention to what it calls its most important metric, engagement, well, it makes sense. More eyeballs equals more ad money. It's the right thing to do. These guys do very little that's wrong. Management says they're already seeing momentum in the ad tier, with membership on ad plans up 35% quarter over quarter. These plans account for over 50% of new signups in the countries where they're available. It's the right thing at a time when people don't want to spend more than $5 for a McDonald's burger. But even ignoring these numbers, management had very bullish commentary about expanding their programmatic advertising capabilities with a company called Trade Desk, whose stock we just love and loved for ages. You know I've been a big fan of the company, and I'm confident they'll be able to get this new ads business scaled sooner rather than later. The rationale just makes too much sense. Old people watching Seinfeld, I'll give them a farm ad. Younger people watching Outer Banks, serve them an Elf Beauty ad. I don't know. Ted Sarandos also gave us some insight on AI, which he says isn't a threat to Netflix, as anything that increases the quality of entertainment will ultimately benefit his business. But AI should also help with placing ads, while making Netflix's recommendation for what to view next even more accurate than before. So terrific. Now, I'm not saying Netflix has become an AI play, not at all. I'm just saying that between the expanding library, clear customer interest, and the ad tier model, and their ability to harness the power of artificial intelligence, we have a lot of positives here, and it's going to translate into a lot of money. Bottom line, if you were worried about Netflix not having enough levers to pull in orders to generate growth going forward, or at least enough growth to justify the stock's price-earnings multiple, I think those concerns have been put to bed by last night's earnings report. Near term, the Netflix bears will hibernate, but just remember all these positives when they inevitably come out of their den and try to maul this best-of-breed company with a stock that I think can rock on higher for a long time. Let's go to Fernando in Texas. Fernando.
How's it going? Good to hear your voice. First time caller.
Thank you, man. I'm glad you called, Fernando. What's going on?
Just looking to see what your thoughts are on Dave & Buster's, PLAY.
Too episodic. You'd be good, then bad, then good, then bad. Best of breed does not do good, then bad, then good, then bad. And I like to buy best of breed. Let's go to Ron in California. Ron.
Hey, Jim, thanks for taking my call. I'm a big fan. I've always enjoyed being educated and entertained at the same time when I watch.
That's what I want. Thank you very much.
Okay. So on September 20th, my wife and I went to the Sphere in Vegas to see the Eagles concert. It was the most amazing live event I've ever attended. The sound and all the videos surrounding us were absolutely incredible. Entering the venue, they were selling lots of merchandise, food and drinks. In fact, an 8-ounce bottle of water with the name Sphere on it was selling for $8. So I figured any company selling water for $1 an ounce had to be a good business. When I came home, I immediately bought shares of the Sphere stock, SPHR. A few days later, the stock got an upgrade to buy from one analyst, and on just this last Wednesday, it announced that it's going to have a second venue opening in Abu Dhabi. However, the stock doesn't make a profit, number one.
All right.
On October 8th, the executive vice president and the CFO, for unknown reasons, decided to step down. And then I discovered that it has a short ratio of more than 8 and a short percentage of outstanding shares of 9.
But, look, we recommend the stock lower. We're sticking by it. It's kind of a great spec situation. Yeah, that's the way I would put it, great spec. When you said the Eagles, the first thing I thought of was like, wow, the Eagles. Did the coach boo the crowd? And then I realized, no, you were talking about the music Eagles, not the team that I spent a fortune going to games for and get booed anyway because I didn't like the product. Who knew? Go to Sphere. They don't boo. Netflix's results last night should do enough to quiet the Bears' fears about its growth prospects. Just remember, all the positives here the next time this best-of-breed company does get hit, because it will, because there's always some analyst trying to make his name blast in Netflix, or her name. Much more Mad Money ahead. Investing Club members send in some amazing market questions for the monthly meeting. We didn't get them all. I got to show you what the club is really like. If you don't really belong, then I just presume you don't really like stocks. Well, why are you watching? Okay? Boo. Oh, I'm sorry. No, I'm not a coach. Then, sometimes in business, you need to recognize your vulnerability and become something else, or else face the fate of disruption. I'm sharing a couple of ideas to help you invest in the thesis. And, of course, all your calls rapid fire in tonight's edition of The Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.